Apple beat on earnings and revenue last week, yet the stock was still punished. Now that earnings volatility is gone, is this a buy the dip opportunity or the beginning of a larger breakdown? Let's jump over to the charts. Let's walk through what happened to Apple leading up to the earnings last week and how the market reacted to the news as well, and what that potentially means for us looking for new trades for the rest of this week. I'm using Apple as the example, but this is the process that I use for all names on my watch list. A lot of the Mag 7 stocks that we trade are in similar scenarios. They're all coming off of earnings related moves. We're looking for ways of identifying new trades going forward. So I'm using Apple as the example, but you can use this same process for any of the other names on your list. I always like to start out with the daily chart, which I have up on the screen here for Apple. I'm not looking for exact entry and exit points off of this chart. I'm just trying to put context around where we have been and where could we potentially be going. And if I take a look here, you'll see Apple had this really nice move to the upside going into earnings. It was rock solid. It was leading the market to the upside, definitely aided by the large buyback program that's in place. Apple's got that in place to protect the downside, right? It's really hard to get any sustained selling for any length of time because of that buyback program, right? So you've got this move to the upside. And the reason I point that out is oftentimes going into earnings, you can have the earnings come out and they're great numbers. They look good on Apple last week, but the stock still moves lower. And that's why it's so hard to trade leading into earnings. Oftentimes it can turn into a buy the rumor, sell the news type of an event, right? We had the buy the rumor on the way to the upside. And even though the numbers looked good last week, the stock still sold off, right? There's too much that has to go right in your favor to make money consistently through earnings. It turns into an all or nothing type approach in many cases. And I talked about it in a recent video here on the channel, how I don't like to hold positions through earnings. It's just too aggressive. I just find there's so much that has to go right in your favor to make money. It's just not worth the added stress long term. You just don't see a consistent enough return. I would rather sit the earnings out and then play the reaction. So here we are. We sat the earnings out. Now what do we do? Well, if you take a look, the move to the downside came out just shy of some pretty key support levels. We've got our dotted blue lines there on the chart. These are the 100 period and the 89 period EMAs. We've got support there at 298.52 and 295.97. We are approaching some support levels that, if they are tested, I believe are going to hold. I don't believe we're going to see this stock fall out of bed. I don't think we're going to see a sustained downside move. This market has been incredibly resilient. And if we're going to see the dip bought up, they're most likely going to go back to some of those big heavy hitters like Apple. So does that mean I just go in and get bullish, buy long calls, expecting to move to the upside? For that to play out, I need to see price confirm first. At a minimum, I would like to see, to get aggressive on the bullish side, I want to see price back above the 50-period SMA and EMA. Those are the yellow lines on my chart. So I would need a clear of 310. We're nowhere near that yet. So does that mean I lean onto the bearish side, expecting more follow through on the downside? No, because the stock has already made such a big move. Oftentimes what will happen after the big earnings related move, a stock will start to chop. It'll start to digest the move, and in this case, start to build a base to bounce off of here in the days and weeks ahead. As a result, I would rather, instead of buying an option expecting a big directional move, I'd rather sell premium here. I'd rather sell a credit spread to get that time decay working in my favor. That way, if we do just chop and digest the move, I can work with that. I can still make money from that time decay adding up in my favor, right? Notice what happened last week after the earnings. The volume was very large. The range, the ATR down at the bottom, look how the range spiked to the upside. It was an outlier type day. Now that we've given it a day or so, notice what's happened. Volume has started to roll back over. The range has started to stabilize a little bit. Now we're starting to see things return back to normal. So now I go from the daily chart where I'm saying, hey, I'd rather lean a little bit more on the neutral side and get that time decay working out in my favor. Now let's go down to the hourly chart. And now let's start to take a look at some potential entry points. And if I jump down to the hourly chart, take a look what happened last week on the pulse indicator. Notice how we had blue popping up on the pulse. We had price down at a 4 standard deviation move on the downside. When you start to hit a 2, a 3, a 4 standard deviation move, you're talking about less than 0.2% of all occurrences that fall outside of that range. Doesn't mean we can't move lower from here. It just means it's not statistically probable for a big extended move on the downside. odds will favor either a period of consolidation or a bounce higher. Notice how I have my blue dots here popping up. That indicated an oversold condition where if I hit those blue dots, now I'm looking for a bounce. Now I'm potentially wanting to sell a put credit spread to benefit from a sideways move or a push to the upside. So where I was looking to potentially lean on the bullish side is anywhere above 302.50 on the hourly chart. And that level was hit. Right? I didn't take the trade initially last week because I was trying to avoid the outlier earnings move. Now that we're here Monday, starting a new week, we're starting to see things return back to a normal type environment. These blue dots right here indicate it's a green light for me to lean in a little bit on the bullish side with that neutral kicker. It's a put credit spread opportunity. Right? If I take a look over at one more chart here, you'll see that I have my short-term EMA. Okay, ideally for us to really get things going on the upside on the hourly chart, I'd really want to see price clear 306 tomorrow or even into Wednesday. If we can start to see a close above 306 and then 310, now all of a sudden we've got some confirmation that a near-term bottom could be in place and we could potentially see a nice little bounce here the rest of this week or even into next week. This is not me trying to establish a long-term position. I'm not looking to hold this for months on end. I'm saying for the next 3 to 6 days, could we start to see a little bit of a bounce? Is there a way for me to play it? And here's how I play it. Let's go over to the trade page. And let's take a look at Apple. We all know Apple, along with many of the other Mag 7 stocks, they're incredibly liquid. They've got great liquidity in the options. They've got a lot of expiration cycles available to us. Just a lot of options here that we can work with. So let's go to the August 10 cycle. Those are the 7-day options. They expire next Monday. All right, so let's go out 7 days and let's take a look at the put side. And let's go out to the 297.5, 295 put credit spread. It is a $2.50 wide spread. I'd be selling the 297.5 put, buying the 295 put at the same time. Doesn't mean it's overly advanced, doesn't mean it's going to tie up a ton of capital. This is actually much safer than buying a long option. It's going to tie up less capital in many cases, and it's also going to give us 5 ways of making money versus only having one way of making money when we buy an option. So at the close here today, it was trading for 61 cents mid-price. Normally for my credit spreads, I like to be in that risk 2 or 3 to make 1 range. In this case here, I'd be risking 189 to make 61, just outside of that risk 3 to make 1 window. Before we talk about this one in more detail, let's just adjust the strikes here one more time. Let's go down to our short strike and let's move it up to the 300 and then the long strike to 297.5. Gives us a little bit more premium to work with. Yes, I'm going to have to move my short strike closer to the stock price. In doing so, it puts a little bit more directional pressure on the trade, which I don't mind because we're already so drastically oversold. But look what it does to the premium. Now I'll bonus my premium up to 85 cents. Now I'm risking 165 to make 85. I'm risking closer to 2 to make 1. I like that ratio, right? So I'm taking a little bit more directional risk there, but in exchange, I get a better profile on the trade. If we were to take this trade, I'd be collecting $85 per spread. I'm only tying up $165 of our capital per spread. If I compare that to buying a long call, look at the call options here. You're potentially looking at $500 or more to buy a long call, and you only have one way of making money. The stock would have to move to the upside quickly. By using the put credit spread, we lower that cost all the way down to $165. It's still a fully risk-defying trade. We're tying up less capital, and now I give myself 5 ways of making money. Up, down, or sideways. As long as price stays above 300, I'm okay. I also benefit from the time decay adding up, and I benefit from volatility contraction. Any combination of those 5 will help me out. Ideally, in a perfect world, we get a move to the upside. That's going to push me into profit the quickest. If it doesn't, if we just sit here and chop, I can make that work as well. I just have to hold a little bit longer to let more time decay add up in our favor. Would I hold this all the way up to expiration? I wouldn't. My target here would be 50% of max profit. All that means is I'm going to take my entry price, in this case 85, I'm going to divide it in half. I'd be looking to buy it back and close it out for around 42 cents. That would give me 50% of max profit on the trade. The 70% stop, I would take my max risk of 165. I would take 70% of it, which is $115, then add in my entry credit of 85. and that would leave my stop price at $2. All right, so if I were to get out there at $2, it would leave me with 70% of the max risk as a loss. Okay, very typical ratio for us on a credit spread. So I like this trade. Again, it's not me trying to put a stake in the ground saying, hey, the bottom is in, we're going to rally up the rest of the year. Not the case at all. In most situations like this with a credit spread after earnings, I'm looking for anywhere from a 2 to 4 day hold on these types of trades. So I'm able to get in, book my profit, free up that capital, and move on to something new. So again, Apple's the example here. But if you wanted to go over to Amazon, Microsoft, Meta, they all had earnings. SpaceX is going to come out with earnings here after the close. You've got a lot of opportunity here to play the reactions to earnings, and there's a lot of great probabilities long term by taking this type of an approach. So that's what we're going to do on Apple. If you have any questions on this specific trade, feel free to leave a comment here on the channel. More than willing to help out there. If you wouldn't mind, like and subscribe to the channel. That would really help us out as well. And as always, if you have specific topics that you would like us to cover in more detail, let us know. We are here to make sure you get your questions answered, and we'd love to help you with your options trading. So I'm going to wrap this video up here. I'll be back with you guys here later this week with our next video.